Welcome to Module 4.2. In this module, we're going to talk about three different learning objectives. The challenge of stock screeners, what is the TIP value multiple, and why does the TIP value multiple outperform the market? When I took my first step into the stock market, I found it completely overwhelming. There was so much information out there and I didn't know where to either start or stop. Imagine how excited I was whenever I learned about the concept of a stock screener. I've always been very quantitative in my way of thinking, so not only did I think it would save plenty of time in my stock investing research, I also had the idea that if I only learned how to adjust my stock screener just right, I would automatically get the best output without doing any kind of extra work. My train of thought went something like this. I would start up with a universe of, say, 10,000 stocks, and first I wanted to identify stocks that were cheap compared to its earnings. Okay, so for instance, if I looked at stocks with a PE less than 10, I might end up with 1,000 stocks. I also didn't want to pay too much for the assets of the company, so I would set the price to book ratio to, say, less than 1.5, which would take me down to 100 stocks. I also really like the idea of having a company with not too much debt, so I would typically look for companies with a debt to equity ratio less than 0.5. And in my world, it would give me anywhere between 20 to 30 stocks, which seemed to be an adequate size for my portfolio. In reality, however, this was very far from what actually happened. Whether I used these three criteria or something completely else, whenever I put them into a stock screener, I typically ended up either with hundreds of stocks or no stocks at all. The latter was especially true when I tried to add even more metrics. Because the more I learned about key ratios like free cash flow, dividend yield, the current ratio, the more I wanted to add more key ratios as it gave the illusion of just one perfect stock. However, even with the help of a stock screener, the perfect stock just didn't seem ever to pop up. Whenever I tried to manipulate the stock screener to find those 20 to 30 stocks which I originally considered the right portfolio size, I faced a completely new problem. If I came up with 200 stocks, which were too many or no stocks at all, from all my inputs, how could I decide which metrics to either tighten or loosen? The stock screener that appeared to be the answer to all my struggles of identifying the right stocks for my portfolio turned out to confuse me rather than helping me. Now, this is not the same as saying that a stock screener is useless at all. As a place to start your research among all the stocks in the universe, you will be well off using a screener. My main worry is that of the output that you do get, you're still in for a lot of work. And regardless of how you have set your screener, you'll need to make a qualitative analysis. We saw that in Module 3 where Preston taught us about the mode of the business, quality of earnings, growth rate, and much more. Regardless, this was how I for a long time found my stock picks. And to be honest, I wouldn't have been without that process. As time-consuming as it was also incredible, rewarding to study company after company in detail. As I went on in my investing career, metrics that I never heard about seemed to reveal itself time and time again wherever I looked. They popped up in academic papers and in various books and articles that we read here on the podcast. Actually, the more we studied billionaires, the more it seemed they were using a very quantitative approach to find the best stocks. Sometimes they even used a purely quantitative approach, meaning they would be investing in stocks according to a formula, and then they would buy all the stocks that the field told them to, without doing any kind of personal analysis. What made the difference to me was when I had the chance to personally ask Bill Miller what he thought of the metric called the enterprise multiple. In case you don't know Bill Miller, he is one of the best known investors in the value investing community. He has a personal net worth of more than $500 million and has managed more than $75 billion in his portfolio. And he endorsed a screening technique too and told us that he typically used a similar technique focusing on the free cash flow. When researching even more here on TIP, we found an extraordinary performance when we came up with a slightly different version of the enterprise multiple and Bill Miller's multiple, and we decided to call that the TIP value multiple. The equation of the TIP value multiple is enterprise value divided by EBIT. The easiest way to think about the TIP value multiple is that it's the cheapest way to buy into your share of profit for a company. You can think of this similarly to the PE. In other words, how much do you have to pay for $1 of earnings? You'll probably not be surprised if I told you that research show that a low PE stock typically outperforms the market. Now, the TIP multiple is an advanced version of the PE multiple, creating to capture a higher market outperformance. It includes debt, cash, minority interests, and much more all in one metric, and it's the metric that seems to show the most sustainable outperformance of them all. In Module 4.3 and 4.4, I'll break down the TIP value multiple in detail, but for simplicity, in Module 4.2, you can simply think of the TIP value multiple as the PE. Now back to where we were before and my chat with Bill Miller. When I started to rank the stocks that were trading at the lowest TIP value multiples and comparing them with the stock picks Bill had invested in, I found many duplicates. This could hardly be a coincidence, right? So how much has the TIP value multiple outperformed the market? Well, if we look at a huge dataset from 1964 to 2011, the S&P 500 returned 9.28% annually if we reinvest the dividends. If you, on the other hand, bought the cheapest 10% based on the TIP value multiple, you would achieve a 14.55% return, or more than a 5% outperformance. So how much of a difference is that really? Well, if you had a portfolio of $10,000 and invested that in the market January 1st, 1964, and compounded that until December 31st, 2011, your portfolio would have grown to nothing less than $700,869. Not bad at all, right? If you, however, had invested with a TIP value multiple achieving 14.55% annually, you would end up with $6,788,354. The outperformance seemed almost too good to be true. So I started to research why the multiple performed so well. And surprisingly, the businesses trading at low multiples were highly unattractive and had grim prospects to say the least. Now, that might not make any sense to you because I just said that they will be outperforming and still they'll look unattractive. Well, remember that the prices in the stock market are nothing more than the last price investors think each stock is worth. That means that if for one reason or the other investors find one stock unpopular in particular, you'll be able to buy it at a very low price. You won't find low TIP multiple stocks in fashion or in high growth industries. You'll rather find boring businesses with unappealing prospects, showing a way too unstable track record for you to get excited. Well, that being said, that you can find highly unattractive businesses out there is the same reason why the TIP value multiple works. First of all, people have very low expectations for these stocks. The price of a stock is not a reflection of how much money it has generated in the past, but rather the expectations to what it will make in the future. You will often find that companies that never made a cent in profits to shareholders, and therefore is funded by issuing equity or taking on debt, are trading at surprisingly high prices, simply because investors have high expectations for their earnings in the future. The same way you experience that companies with a strong record suddenly trade at a very low multiple because the market simply has overreacted to insignificant news about the company, or sometimes, for no reason, the market simply no longer believes in the future of the stock. Regardless how the market has reacted, we can observe that the market misprices stocks based on expectations. Now, let's talk about the second reason why the TIP value multiple works. Imagine that I propose to enter a bet with you. I'll flip a coin, and you'll pay me $1 every time it's heads, and I'll pay you $2 every time it's tails. Clearly, this is a good bet for you. Your expected return for each flip would be 50 cents, and it would only be a question of time before I would run out of money. Now, in the short run, this might not be a profitable investment for you. You might lose 10 times in a row. But over the long run, we will approximately have as many heads as tails. This concept is known as mean reversion. Over time, whatever we measure, we will revert to the mean. This goes for flipping a coin and for stocks. Overall, stocks trading in high multiple disappoint the market participants when they realize that the high expectations can't be met. Perhaps you know this concept as growth stocks. The stocks that are trading at a low TIP value multiple, on the other hand, deliver much better results than the absurdly low expectations that are typically attached to them. Remember, they are highly unattractive businesses. In the short term, they might be priced even lower, but in the long run, once the market has realized the intrinsic value of the stocks, they will soar, and as a result, they'll vastly outperform the market. The more I researched the TIP value multiple, the more it was not a question whether I should follow such an investment approach, but rather how I should apply the TIP value multiple in practice. I'll teach you what I found when I take you through the process step by step in Module 4.5. For now, I'll transition into Module 4.3 and start breaking down the formula for the TIP value multiple.